If you're a high earner with company stock, or you've used your brokerage account for a bigger expense this year, there are some year-end tax considerations worth reviewing before December 31st. These are situations where people can get caught off guard with unexpected tax bills. But when you plan ahead, as we do with our clients, they can be handled without stress, and you can potentially avoid some costly surprises. A couple came to us specifically needing tax planning support. They were already used to having sizable tax payments each year, but this year was different. Multiple lots of company stock vested at once, creating a much bigger income event than they normally have. They had no idea what kind of impact this would have on their taxes, and they needed help. When your restricted stock units or stock options vest, that's treated as ordinary income, even if you don't sell a single share. If you're not planning for this, you can end up with a large tax bill and no cash to pay it because the money's tied up in company stock. One strategy we use is to model out vesting schedules at the beginning of each year. We look at what's vesting, when is it vesting, and whether you may need to set aside cash or adjust your withholdings to cover the potential tax impact. Some people choose to sell shares immediately at vesting to cover the tax liability. Others prefer to hold, but then we help them build a separate tax reserve. Before year end, these are the questions worth reviewing. Did any shares vest this year that I haven't dealt with? What's vesting next year and when? What's my plan when those shares vest? Should I sell immediately or should I hold? Have I modeled out what I may owe in taxes? If you're not clear on the answer, this is worth reviewing before January 1st. Now, stock compensation is one way people can end up with unexpected tax bills. But there's another situation I see that can create a similar problem. And it happens when you use your brokerage account for bigger expenses. A new client came to us when she had just had her previous advisor sell positions for a few bigger expenses, like a car and a big family trip. She had the cash she needed, but when we started working together, she realized she owed a lot more in federal capital gains taxes on the sell than she was used to paying. Now she needed to sell more investments to pay the tax bill, which would trigger more capital gains, which meant more taxes next year. It's a cycle that's hard to break once you're in it. What people don't realize is that when you sell investments in a regular brokerage account, which we refer to as a lifestyle account, you may be triggering capital gains taxes. If you're not planning for that, you can end up selling more the next year to cover the taxes, which really compounds the problem. This applies to any big expenses where you liquidate investments in a taxable account. This could include a down payment, a renovation, a car purchase, a large vacation, even paying a tax bill from the previous year. One strategy we use is to plan before you need the cash. If we know a client needs, let's say $150,000 for a down payment or a big purchase, we work with them to map out tax efficient ways to raise that money. Maybe we spread the sale across 2 years to stay in a lower capital gains bracket. Maybe we harvest losses to offset gains. Maybe we use a line of credit temporarily. There are different approaches, but they work better when you plan ahead. If you've already sold investments this year, it's worth calculating what you may owe in capital gains taxes so you can plan for that payment. And if you're thinking about tapping your brokerage account for a big expense next year, now's the time to map out a strategy. So we've covered stock compensation and brokerage account taxes, both situations where you can end up with an unexpected tax bill if you're not planning ahead. Let's bring this all together with why this year-end review matters. Most high earners are dealing with multiple moving pieces: bonuses, stock compensation, multiple retirement accounts, brokerage accounts, maybe rental properties, or even a side business. Each has tax implications, and if you're not looking at the full picture, you may be overpaying in taxes or setting yourself up for a surprise. Year end is your last chance to make adjustments before the calendar year flips. Maybe that means maxing out a health savings account contribution. Maybe it means harvesting some losses to offset gains. Maybe it means adjusting your withholdings for next year. But once January 1st hits, many of those opportunities are gone. If you're a high earner and you're not reviewing your tax situation before year end, you may be leaving money on the table or setting yourself up for an unexpected tax bill. We help clients work through these considerations and figure out what moves make sense for their specific situation. If you want to talk through yours, let's schedule a time.